This panel is precisely about risks in the global economy and how public debt managers are thinking of dealing with them. We couldn't have a better panel. We have all professional practitioners here of debt management. We only have 1 hour, as I understand it, and we need to leave some good time for questions from all of you and some good dialogue before we end at 11. I'm not going to invest our time in reading the full bio of any of our colleagues. I'm just going to mention their names and affiliations, starting from my extreme left, not politically, just geographically. Blerina Urici, you never know. Blerina Urici is director for US Economics Research at Barclays Capital. In the center, we have Fred Pietrangeli, a director of the Office of Debt Management at the US Treasury. And finally, to my immediate left, we have Herman Camil, who is the head of Sovereign Debt Management Office at the Ministry of Economy and Finance of my beloved Uruguay. I'm going to give each of them about 4 to 5 minutes to make some initial comments, and then we are going to keep it lively as much as I can and try to provoke some thoughts and reactions from all of you. Let me start with Blerina. If you can perhaps set the stage for us as to what should be the baseline for any practitioner. I mean, what should we expect? Big trends, US, Europe, Japan, China. What are you telling your clients? At least for the baseline, your most likely scenario, if not highly likely scenario.
Sure, I'll have a go at summarizing that in 4 minutes. I use my hands a lot, so you'll excuse me if sometimes my voice fades. At Barclays, we expect the global economy to grow at about 4% this year. That's accelerating a little bit from where we were last year, and we think it's probably going to slow a little bit next year. So we're looking at 2018 as a point in time where the global economy has experienced this as good as it gets, and it's peaking in many ways. And the reason for that is that for quite some time now we've been having this synchronized growth in both developed and developing economies. So recovery is coming at the same time. We're seeing a divergence now in the path of recoveries across DM and EM lines. And also we've seen this increased momentum in trade flows, and again, that momentum seems to be slowing now. So that makes us feel like perhaps growth is also going to slow into 2019. And so I was mentioning earlier, we're seeing this gap emerge between developing market economies where the recoveries continue at steadfast pace, driven or led by the recovery in the US, where growth has accelerated significantly this year. And then we're seeing some risks in emerging market economies coming from idiosyncratic situations in specific countries such as Turkey and Argentina, but also linked with the FX funding and liquidity drying up a little bit and credit flows in general. So more specifically, for the US, we expect this to pull ahead of the pack in many ways, with both domestic demand in the US and the financial markets being supported by the tax cut that we saw at the end of last year, and also the fiscal package earlier this year. Both things mean that growth in the US is probably above potential right now. We expect this to continue well into the middle of next year, but then as this sugar high of the economy sort of wanes, we expect in the second half of 2019 for the US growth to go closer to potential, really, but still to overperform other developing economies. In Europe, we expect euro area growth of about 2% this year, maybe slowing by 0.2 in 2019. And again here, solid demand across many euro area countries, domestic demand driving growth, and then some headwinds from the external sector that should hurt in particular manufacturing and industrial sectors. China is bearing the brunt, it seems, of the increased trade tensions. We think they're weathering this pretty well so far, and our baseline scenario is that they will continue to do so, but nevertheless, risks remain there, and we already heard that China is a big factor, a big systematically important piece of the global economic puzzle, so it matters a lot. In terms of elsewhere in EM, we have those downside risks that we mentioned earlier, Argentina, Turkey, idiosyncratic domestic issues there, but also linked with international funding. We think that these countries, what's happening there is very important for those economies and for the welfare of those citizens. At the moment, it doesn't pose a systemic risk to the global recovery. So based on that, we expect the recovery to continue. In terms of inflationary pressures, we've seen some firming up both across the US, Europe, and Japan here. A lot of that has been driven by commodity and energy price increases. When you look at core inflation, this is still struggling to gain momentum, and that recovery in core inflation post-crisis has been really painfully slow. The US and the Fed here can claim victory to some extent because we're now at full employment and also core inflation at about target, but we expect in the euro area and in Japan, inflation to remain well into 2019 below the 2% target for the ECB and below BOJ's target as well. And when it comes to China, we're seeing the PBOC's policy bias, and this will be my final point, so we're on time, I think. We see their monetary policy biases being loosening, and we're seeing that in terms of trends in liquidity provision and trends in interbank rates as well.
Thank you very much. That's very clear. Fred, your economy is on a sugar high, and that's what we just heard. Is that giving you a heartburn as a debt manager? What are the drivers? What are the things that are making you change your strategy if you are changing your strategy? We know you are introducing new instruments, the floating rate notes being one case. What do you see coming forward as a debt manager with all these macroeconomic framework in front of you?
Yeah, so I think the idea of a sugar high might be debatable amongst some economists. There's some folks that think that this is more than just kind of a short-term fiscal impulse and that it might carry on forward. Certainly OMB's forecast, when you look at them, suggests that, well, interest costs are going to rise and debt to GDP ratios will rise through 2022, 2023, it'll start to fall after that. Just in terms of overall drivers of our debt issuance, obviously there's whatever debt is rolling over. We also face seasonal factors in debt issuance. So for example, when tax refunds go out in early March before April, we increase bill issuance pretty dramatically to cover those seasonal flows. More structurally speaking, though, there are, you know, the tax law changes that occurred have resulted in higher deficits. In addition, we have what's going on with the normalization of the SOMA portfolio as a big factor. That can, we estimate that that's going to add anywhere between $500 and $600 billion to funding over the next 3 years. You know, in terms of our debt issuance policy, for some 40 years now, we've adhered to this concept of regular and predictable issuance. The idea is that our issuance needs are so large that we do not try to do anything opportunistically in a manner that will shock the markets. So the marching orders are always try to be as transparent as possible in terms of what we think are either seasonal borrowing needs or structural borrowing needs. You know, to that end, we've done a lot of work recently with regard to debt issuance. There's a paper that the Treasury Barn Advisory Committee just published on, through Brookings that has a model that they developed. We've done a lot of internal modeling at Treasury as well that suggests that in terms of debt issuance, when we think about it, we are better off from a risk-reward proposition issuing in the belly of the curve. So, you know, if you consider kind of the term premium that you pay in the long end to reduced volatility of interest costs, there's more of a saddle point in the belly of the curve. So if you look at our issuance over, our issuance increases since February of this year, we've issued across the curve, but we have been skewed more towards kind of the 2, 3, and 5-year tenor points in terms of our issuance. With regard to floating rate notes, that, you know, let me step back and just say that anytime we think of new issuance, we kind of run the product through a series of first principles. And one is there sustainable demand across all interest rate cycles for the product? Second kind of principle that we want to test is, you know, does the distribution channel, i.e. the primary dealers, do they have the means to be able to inventory and warehouse the risk for underwriting that debt? And then the third thing is, does the new product in some way expand our investment base or diversify our funding? I mean, the last thing we want to do is cannibalize existing products through bringing about new issuance. So with regard to the floating rate note, you know, that was a decision that was essentially targeted to individuals that wanted short-term interest rate exposure, but also wanted to avoid having to roll over bill financing. And in particular, you know, central banks are a huge buyer of that particular product, but also there are a number of investors that use that product for margin purposes. So if you're thinking of a product that you want to use for margin purposes, you know, having to worry about rollover is somewhat problematic. So here you can buy something that basically has bill exposure, but you don't have to worry about the operational risks of rolling that over.
I pick from you this idea that you don't want to shock the market, and we thank you for it because you're so large that, you know, little us will be in trouble. But that's a great segue to Herman, because, you know, here is a country that is very well run. Uruguay can teach us a lot, very conservatively managed, with a super professionalized public debt office. But you do see the big players going into a normalization of interest rates, which we all translate into 2 or 3 rises in the next, say, 9 months. How do you prepare for that? How do you keep being so well managed when, you know, we know that there is no shock coming, but you never know. I mean, we've seen it before. So what do you do?
First, thanks for your kind words. So the way we see the current context is as characterized by very high market volatility, rising trade tensions, and mounting political uncertainty. What we see as a major risk from the management point of view, aside from trade tensions, could be a sharp monetary policy adjustment in the US, a sudden increase in interest rates in the US, especially in the longer part of the curve, that could lead to a shift in market sentiment and a sudden retrenchment of portfolio flows from emerging markets. Now, naturally, the prospects for individual emerging markets will vary depending on their main characteristics. For example, their macroeconomic fundamentals, their political uncertainty, and the perception by the market of the need of a policy adjustment. So those prospects depend on how these global forces interact with idiosyncratic factors. In the case of Uruguay, as Marcelo was saying, we have been preparing for this backdrop of increasing interest rates and a stronger dollar appreciation. And we learned it the hard way. At the beginning of the century, all of government debt, almost all of government debt of Uruguay was denominated in dollars, and most of it, or a big part of it, was short term. So when the crisis hit in 2002, and the ensuing devaluation exposed big sovereign balance sheet currency mismatches in Uruguay that were a key source of vulnerability. Moreover, because economic activity in Uruguay is negative correlated with the exchange rate during downturns, foreign currency debt became a bigger burden exactly at the time where our debt servicing capacity was lower. So for Uruguay, dollar debt is intrinsically risky. So how did we prepare? Over the last few years, we have actively increased our reliance and borrowing in domestic currency, both locally and also internationally. And also we've limited the impact of an increase in interest rates by extending the maturity of our debt. Our average maturity of our debt is today 14 years, close to one of the highest in emerging market countries. In particular, last year we were able for the first time to issue in global markets local currency sovereign debt in fixed nominal terms. This was a milestone for us. What this allowed was to access a pool, a big diversified pool of investors that had appetite for peso exposure. But this was more than a funding exercise for Uruguay. It was also a market development exercise because we were able to establish liquid benchmarks on the nominal yield curve of the sovereign, providing pricing references for other market instruments, both from the public sector and the private sector. Now, we also have pushed in our de-dollarization agenda by engaging with multilateral institutions and tried to convert part of our standing dollar debt into pesos. Now, typically, multilateral institutions will provide local currency conversions if they can hedge that local currency risk in the swap market. Now, in the case of Uruguay, our swap market tends to be rather limited. So this was a challenge, but it was also an opportunity because we had to develop both with the World Bank and the IDB innovative financial structures to de-dollarize. So just to give you an example, this year we converted a dollar outstanding loan with the World Bank that required a concerted effort between the Treasury of the World Bank, the government of Uruguay, investors that demand World Bank bonds, and dealers in the derivative markets. Now, it's typically easier for a country to de-dollarize, to borrow in local currency and pay down dollar debt whenever global liquidity conditions are benign and the exchange rates of the emerging markets are appreciating. But that's exactly the time when ex-ante and probably ex-post rates in pesos are more expensive. So to run a counter-cyclical debt management policy, you not only need to have an understanding, say, of the financial engineering, but you need the political backing. There's a political economy angle to it, that is the willingness to incur in the short-term costs of issuing in local currency and bearing those costs for the benefit of a more prudent long-term debt management strategy. The other point that has been a pillar of our debt management strategy is to run a very conservative pre-funding policy. For example, right now, our total government liquid assets, the governments, not the central banks, plus the multilateral credit lines that we have, are enough to cover almost 12 months of future debt servicing costs, interest and amortization. And we are very well aware that being so conservative has opportunity costs, basically the cost of carrying and holding those reserves. But for us, this is like an insurance, and the opportunity cost is a premium because we are of the view that the most expensive money is the one we cannot get during times of stress. So we will continue with that prudent debt management. So what are we thinking of doing going forward? First, we wanted to continue to de-dollarize our debt portfolio, de-risk our debt portfolio, and a lot has to do with continue to de-dollarizing it. But we need to do it in a fiscally responsible way. That is, paying attention to what's happening with our nominal interest rates, which are now rising because they embed more expectations of devaluation and more currency risk. Within the local currency instruments, we have also been working to introduce instruments that allow a better hedge against output shocks, that is, to government revenues. So we are able to better share the risk between the government and investors. So for example, this year, for the first time, we issued in the domestic market Treasury notes in local currency linked to wages. And that was after the Congress was able to pass a law creating a new unit of account linked to the wage index. So this provides to us a much better hedge during downturns. And finally, we will want to continue in a process of conversion of our outstanding dollar debt with multilaterals because we think that in itself is a market development exercise because it provides more depth to the swap market of Uruguay, and also it gives more visibility to Uruguayan credit.
Very clear. Just a public service announcement. This kind of currency conversion service by the World Bank Treasury is available to all of you. We love Uruguay, but it's not exclusive for Uruguay. They just were the first to tap on that window. So, but it's open for everyone. Okay, let's spice it up a little bit. We have from Blerina a very nice cruising scenario. Let's bomb it a little bit. I mean, let's see, and of course this is totally off the record, what would completely derail your scenario? Are we talking about the trade war, full-fledged, 10% of GDP in each of the two countries being affected, global value chains interrupted? Are you talking about an Italy-driven euro crisis? Are you talking about the subnational debt issue exploding in China, or at least becoming more contested? Are emerging markets able to derail your scenario, Argentina, Turkey, maybe Brazil? What are the black swans that you are looking at?
Okay, so completely off the record and confidential in front of over 100 people. Sure. So I'll pick on just two. There are many we could discuss here, some of them raising their ugly head as we speak, and turmoil in financial markets as well. But let's pick two. I would pick on the escalation of trade. Let's not call it war isolation, let's say, and also monetary policy normalization and increased interest rates and what that could do for many EM countries. So thinking about trade isolation, we have been living in this period of steadfast increases in global trade flows and interlinkages of supply chains to the extent and with repercussions that we couldn't imagine. But we now live in a very, very tightly interlinked world where things in one country can easily show up in prices and activity and the consumption of other countries. So, but it feels like right now we are at the cusp of change, a change that is being driven by the US, which is telling us that it wants to look at the world and the way it interacts with the world differently and be more isolated and look at its growth outlook differently as well, and how it's going to get that growth, driven mostly by domestic factors that promote domestic jobs and so on. And the way this is manifesting itself is in this increased trade tensions with countries with which it has a very large trade deficit. For now, China is bearing the brunt of that. There was NAFTA as well, but the latest de-escalation of that and negotiation of the USMCA, quite a mouthful, seems to have put that more at the back burner, and now the focus is China. We've done some modeling at Barclays in terms of what this trade escalation could do to global trade flows, and our findings are that the effects are likely to be modest and to diffuse so long as the US does this incrementally in terms of increasing tariffs incrementally, and also so long as it is contained in this bilateral relationship or bilateral trades with China. If this spreads more globally and if the increases in tariffs are quite abrupt, there could be more severe consequences. So in our baseline, we look at a 20% tariff. You put that on all your imports from China. What does that do? It pretty much lowers GDP, it lowers trade flows for the US, so exports and imports together, by about 1% of GDP. For China, is about 1.5% of GDP because its economy is more geared toward trade. And again, here it hits China more because of the composition of its economy. We assume that China retaliates tit for tat, but of course it cannot do as much as the US can because it doesn't have that kind of a deficit with the US. Should this tariffs be imposed on all imports into the US, 20%, that can lead to trade flows slowing by as much as 5% at the lowest end of the estimate. But of course, in our profession, what we want to warn people about is that this is just capturing the trade channel. It's not telling us what this could do to confidence, what this could do to firms' decisions about employment and investment, and what this could do to financial market confidence, and how if traders, we're talking a lot about these young traders, if they put risk of trades, what's that going to do to the rebalancing of portfolios? So those are risks that are worth bearing in mind, and probably mean that the implications could be much more severe than we can measure with trade flows and impacts on GDP and so on. The other thing, and also the repercussions would probably be more severe for emerging markets because they rely more on trade, and a lot of the growth and prosperity that we've seen over the past decades in these economies has been driven by the external sector and this export-driven growth. So that's how I would divide it between DM and EM. And this dovetails nicely into the next risks that I want to highlight, which is monetary policy normalization. So earlier we discussed the fact that we're seeing this dichotomy or divergence between growth and inflation trends, and what that has translated itself into is a divergence in central bank policy as well, where we have the Federal Reserve reducing its balance sheet and also increasing interest rates at a time when other central banks are still expanding their balance sheet. For the ECB, we think they'll probably stop QE by the middle of next year, but they're still doing it. So what could this do to the global economy? If we're right and the Federal Reserve increases interest rates one more time this year and then 4 more times next year, well, markets haven't really priced that in yet. They didn't believe us earlier this year when we said that the Fed would go 4 times in 2018. So once that gets priced in, there will inevitably, and interest rates increase to about 3.25% by the end of next year in the US, there will inevitably be some rebalancing of investment portfolios. And when that happens, typically in the past, we've seen riskier assets and EMs being affected more as money flows into more risk-free or assets that are perceived to be risk-free anyway. And so this happens at a time when a lot of countries and corporates have been taking advantage of this extremely low interest rate environment that we've been seeing post-financial crisis. And we discussed earlier that a lot of global debt is dollarized. Of course, great efforts have been done to move away from that, and I think that's something that is very important. It comes at a critical time, but the truth is you have countries like Turkey where a lot of the private sector debt is dollarized. You have countries like Argentina, and we have an expert here on that, but where a lot of government debt can be dollarized. So that exposes these countries to risks, I think, and investors in general, although EM countries are diverse, but there is this common thread of reliance on external financing, and it seems like right now investors are looking at the EM universe generally with caution for this reason.
That's very interesting. Can I build up a little bit on one thing you said? You said your calculation is all first order, because you say this is the trade impact, almost the arithmetics of the impact. But we also heard from Ken this morning that most short-term trading, or a big chunk of short-term trading, is now done by machines. So you may have a situation in which reason says, get out, and the machine keeps going in. Have you thought about this, what this confidence effect could look like on investment, on consumption, the news effect, no, that the machines may or may not take into account? Have you thought about this?
We've done some modeling around uncertainty and confidence and what that can do to activity. Typically, we'll use the VIX as a measure of volatility, and then that's telling you when things really heat up in financial markets. And what that does is, typically in the US, it has been associated with slowing in employment growth. And from other analysis we have done, we know that payroll data, intrinsically volatile, get revised a lot, but they seem to be very good at signaling turning points in the US. And typically when you have employment growth in the US slow down dramatically from the recovery average, let's say, which has been 200,000 jobs per month in this recovery, when that slows to 170 or so, then you've got about 3 to 6 quarters when your next, I'm not going to say the R word, I don't want to jinx it for the world, but then you don't have a lot of time. So basically, we've done work. There is an association between increased uncertainty and employment really tells us when we're going to hit the next rough patch, let's say.
Very clear. Thank you so much. So Fred, which are your black swans? Are we talking about China rebalancing its treasury portfolio? Are we talking about yet another boost to the deficit in the US, say by a new tax cut? Are we talking about politics after the election 2 weeks from now getting on the way of the raising of the nominal debt ceiling? What are the things that keep you up at night? You look like you sleep well, by the way. Don't get it wrong, but...
Well, yeah, I think my kids keep me up at night, but no, with regard to sovereign debt management, you know, for a long time, and my co-panelists mentioned this, the global monetary situation has served as an incredible tailwind as we have been going through, you know, higher borrowing needs, having to push out more debt as the Fed is normalizing. You know, the U.S. is an attractive market just because of rate differentials. So, you know, one thing that I do worry about is as, you know, Europe starts to tighten more, maybe Asia's less of a risk in this area, but how does that dynamic change? What does it do to borrowing cost? You know, the U.S. market, you know, we benefit from being a reserve currency, deepest, most liquid market in the world. So I'm confident that we can sell the debt, but you know, there's a potential for a repricing of that debt in a way that would increase borrowing costs significantly. The other thing is, you know, there's a lot of people looking at the kind of the flat yield curve and thinking, you know, is that an indicator of recession coming? You know, I always point out to people that the flat yield curve has predicted 10 out of the last 5 recessions. There's a correlation there, but it's not causal. I think when you kind of look at at least the growth picture currently, the unemployment picture, inflation is stable, the Fed's still hiking rates, they're not at neutral yet. And there's some folks that think they are going to even go further than what the market consensus is in terms of having to deal with inflation in the future. I think we're in a pretty good place in the U.S. from a growth perspective for the next several years. But you know, that's not to say that something doesn't happen with regard to trade, for example. And then just for full disclosure, I'm not involved in any of the trade discussions, but I talk to a lot of economists and I try to get their views on this. And so, you know, the hard data is not showing really any significant impacts at this time, but what economists stressed to me and what my co-panelist again alluded to was that there are some non-linearities that can happen, and if other factors such as confidence or that are kind of these intangible soft factors start to play into how people view the economy and expectations, then you could imagine that being somewhat disruptive.
Thank you so much, Fred. That's reassuring, to be honest, being such an important player. Now let me go back to Uruguay and ask, among your black swans, there's no longer Argentina. You know, Argentina used to be the spoiler for your long-term plans, this big neighbor of yours doing things that had an impact directly on your financial markets. At the moment, the big neighbor raised its interest rate through the roof, from about 20 to 60% in less than 6 months. And somehow Uruguay has sailed through the whole thing. So what is the new black swan, if there is one, for an emerging market like yours? No?
Well, first, I would say, indeed, Uruguay is a very small, very open financially country that is nestled between Argentina and Brazil. And historically, our business cycles have been highly correlated. In fact, whenever there was a recession in either Argentina or Brazil, that would spill over into Uruguay more often than not with amplified effects. Now, what we've seen in the last 6 to 7 years is that Uruguay has been able to decouple from the whims of the business cycles in our neighbors, and we have been able to sustain economic growth even in an environment of recession in both countries. So I think there are at least 2 factors that explain that. The first one is that Uruguay has been able to diversify away from the region into new export markets and new export products, so we reduce our export dependence with the region. And the second one is that we also reduce our financial linkages with Argentina. In fact, during the crisis in 2002, one of the key conduits of contagion was Argentines' deposits in Uruguay's banking system and Uruguayan banks lending to Argentinians. Well, after macroprudential regulation were introduced, those 2 factors, those 2 key conduits have been reduced. I would say a key source of dependence or a key source of exposure of Uruguay with Argentina has to do with tourist inflows. Around 2/3 of all tourists that come to Uruguay come from Argentina. So what happens with the real exchange rate in Argentina has a direct influence on our exports of service during tourism. There's also another factor that investors have taken into account and that could explain this the differentiation with Uruguay. It's the fact that over the last few years, over the last decade and a half, Uruguay has been able to keep a strong social and political stability. And this has been based on consolidated democracy, strong institutions, judiciary independence. So investors perceive Uruguay as a bastion of stability in an otherwise very volatile region. So this is a key credit of Uruguay. It's a key anchor to our credit, and it's something that we need to protect as much as we can. So in terms of Black Swan, well, Uruguay has decoupled, but it's not completely insulated from the region. So a bigger recession, for example, in Argentina than the one envisaged could have an impact on economic activity in Uruguay. But again, the fundamentals and policy anchors that Uruguay has developed over time has allowed the country to continue to grow despite the business cycle volatilities.
It's interesting, being sandwiched between Brazil and Argentina these days, you know, I take my hat off to you, right? At least the following few weeks. Look, we are only 5 minutes to our allocated time before we open it to you for comments and questions. Let me go deep in a couple of points that I think will be useful for the audience. Lilian, you are first, and I'll give you the easiest one, which is, what's behind China's performance? Should we worry? Should we not? Should we go deep into the banking system? Should we look at the asset of those banks and reclassified? Should we think that growth will continue because it's very well managed? Just unveil
Just
the
a
miracle.
very easy question. So
2 minutes, by the way.
thank you. Great. That simplifies the job. So, and I have to tread carefully here. It's a very, very important question. But the main thing I want to highlight is that of the systematically important parts of the world economy, I think the outlook for China is perhaps more uncertain than other parts of the global economy. And so far it seems the Chinese economy and the damage to it from the tightening, deliberate tightening in credit flows earlier in the year seems to have been managed, and the consequences from the escalation in trade tensions also seems to have been managed quite well, but historically we know that these types of credit policy, they have long legs, so we may well see some unexpected impacts from that playing out later on. And then when it comes to protectionism and trade isolation, well, that's uncharted territory. We think we can have a good handle on the impact on the US economy because it's such a big, it acts like a closed economy with a great big domestic market. For China, it could be a different story, and the risks are certainly higher there. To get into the specifics a bit more, so we saw growth in China slow to 6.4% quarter-on-quarter annualized in Q2 from over 7% in the first quarter. That spooked people. In China, you don't have this big drops in growth. It's very well managed. But following that, all indicators suggest that there was some stabilization over the summer. Activity stabilized, credit flows stabilized as well. At Barclays, we have our own measure of alternative credit aggregate, and that showed us that credit growth stabilized in August for the first time since October of last year. So credit growth had been slowing significantly, and then it seems to stabilize now. So that makes us have this read and expectation that the economy is going to continue to have this soft landing trajectory, and growth will be above 6% going forward. But of course, risks remain, and the government is trying to do things to reverse some of that intentional policy of slowing credit growth. It's going back in and unscrewing the taps, let's say, if we want to use an analogy to credit, by deregulation, by allowing banks to lend a bit more. It's increasing infrastructure spending to boost domestic demand. Earlier this month, there was a tax cut that came into place to boost consumer spending as well. So all these things are likely to offset, in our view, some of the drag from trade tensions and the impact that will have on exports, and some of the drag from the slowing in credit growth. But again, I would see China as the biggest systematic risk going forward.
Very interesting. And Fred, I have your deep dive question, which is quite predictable. How are you preparing for the normalization for the SOMA portfolio of the Fed? Do you have it all figured out? Perfect coordination between the two institutions? Complete predictability, no shocks? Tell us. We want to hear it.
So it's something, I think this is one of the kind of most slow motion telegraphed moves by the Fed in history. So I think everybody has had time to prepare for it adequately. Again, full disclosure, we are independent of the Fed. We don't have conversations with the central bank. I know it's different in other sovereigns, but since the 51 Accord, there has been this independence between Treasury and the Fed. So our mandate is lowest cost of funding over time. The Fed is growth and price stability. So in terms of the SOMA normalization, obviously it means that we have to issue more debt to the private sector. Just maybe by way of operational explanation, currently when Treasury announces auction sizes, those are private amounts. And when the Fed participates, it's allowed to mature or roll over its maturing debt at the stop-out rate at the auction, but they do not bid in the auction. In other words, they do not submit prices, and the reason that is because that would be basically a violation of U.S. law. They're monetizing the debt. So what the normalization means now is that as they redeem, the amount of debt that we have to sell to cover their redemptions has to be picked up by the private sector. So we estimate that to be about $550 billion over the next 2 years, additive on top of what the deficits would be just because of the fiscal situation. So we're talking upwards of $1.2, $1.3 trillion, depending on the estimates for like the next 3 years in terms of borrowing needs. I will say that the one kind of joker in the deck is that much of the analysis is based on the last guidance that the Fed has given with regard to when normalization of the portfolio would be complete. They have stated publicly December 2020. Lots of analysts are debating what the overall size of the balance sheet might actually be and whether the Fed might want more reserves in the system. And so if you look across Wall Street, there are some analysts that are suggesting that balance sheet normalization could be complete in the latter half of 2019, which would have a significant impact on the amount of debt that we have to borrow going forward.
Very good. And we have 2 more minutes for a deep dive questions on Uruguay, and it's very predictable too. You seem to have carved a legion or a cohort of investors that have clearly accepted, bought into the idea and the storyline that Uruguay is a very well-managed place, conservative, integrated with the world, diversified away from Brazil and Argentina, and you said also with clear social and political stability. That's a very good place to be. But how do you manage the day-to-day with those investors? Is your communication weekly? Is you're looking for new investors or you protect these? Those investors are willing to buy debt in your own currency, so they must know a lot about Uruguay. They're very well informed. How do you do that? I mean, that's very unique.
Yes, if you don't mind, before I jump into that question, you were asking me earlier about the possible impact of Argentina and Brazil on Uruguay, and I think there's a broader theme that we also think is relevant, that is the lack of contagion or a big contagion that we've seen from countries that are running into difficulty in most other emerging market countries. And I think what a lot has to do, and it's a testament to improve communication on the part of countries, but also more transparency in the information that is provided to investors. So that allows investors to make a much better informed decision, a much better investment decision, which in a way explains the differentiation that we are seeing nowadays. In fact, if you look at the number of countries that are rated by credit rating agencies, that has improved dramatically between 2009 and 2018. Take Moody's, for example. Over the last 8 years, 34 more countries have come into the roster of of countries that receive a credit rating. So in a way, you're adding more market discipline, which also helps investors for for better decisions. So what I think that has helped is, rather than seeing a broad sell-off from emerging markets, from the asset class, what you're seeing is a rotation out of the high beta, lower grade countries into the lower beta and higher grade countries. And I think that's one difference compared to other episodes. And also related to that, and I think it's also important for our debt management strategies, what we find interesting over the last year is that the flattening of the yield curve that we've seen in US Treasury yields has not been offset by a steepening of the credit spreads, at least in the case of Uruguay and also in other countries. In other words, the term structure of the sovereign risk perception did not become steeper, what that has allowed Uruguay, and I think other Latin American countries, is to continue to tap the longer end of the dollar curve, which is also a less risky way of borrowing. So going to your question, we definitely glean very useful insights from investors when we talk to them, and also from banks who are in touch with investors and who are typically the underwriters of our syndicated issuance. And I can tell you there are two things they've been highlighting in our interactions with them. The first one, they're concerned about bond market liquidity. In other words, their ability to come in and out of positions without important price dislocations, particularly during volatile periods. And there they've been focused on two things. First, for them, the outstanding size of the issuance is a very good proxy of liquidity and how diversified the bond will be, how big the order book will be. And so they are quite sensitive to benchmark size in our discussions of strategies. The second thing that has come up a lot in our discussions is they want to understand what is the role of institutional investors in Uruguay in our domestic currency markets. And I think that's relevant because while the shift to local currency debt has reduced currency risk, what it has also translated is to an increasing share of our debt in the hands of non-resident investors, which are typically an investor base which is more volatile and more sensitive to global conditions. So basically what they want to understand is whether you have these long-term real investors, pension funds, insurance companies, to step in and to cushion any decrease in prices when there's waning appetite from non-residents. So and we saw this in Uruguay in August during the sell-off in Argentina when pension funds stepped in and allowed a more orderly unwinding of non-resident positions in our local currency markets. The third topic that, and I complete with that it's been in their minds, is that as we develop our domestic local currency markets, investors have focused, have insisted of having more efficient and simpler ways to access our local instruments. And there you have countries in Latin America, for example, Chile and Peru, which has been very successful, which have integrated local currency investors and foreign currency, local investors and foreign investors by adapting their clearing and settlement standards to the international depositories that foreign investors usually are used to using, which is basically Euroclear. So for us going forward, being able to make our instruments Euroclearable is key for increasing the international financial integration of our local currency markets with the rest of the world.
Beautiful, really, really very useful. We have about 7 minutes for questions, comments, debate. There's a prize for the most complicated question and also for the most disagreeing question. Yes, please. Yes, you're on. You're on. Yes. Please.
Yes, my question is related to the global economy and from the panel. And question is, how do we see future of global economy under current scenario of trade war between USA and China?
Okay. Let me go to Blerina. You've been touching on this. Why don't you answer that one, and then we come back to the audience for the other panelists.
Sure. So, so as I was saying earlier, we expect the global economy to grow at about 4% this year, and then to slow a little bit next year. And that is based on a very benign view of how this escalation of trade rhetorics, or I should say relatively benign view of how this pans out. So we basically have the US probably slamming more tariffs on China, averaging 20% on imports from China, and that will slow trade flows between the the Chinese and the US partners significantly by just under 1% of GDP in the US, a bit more in China, and that leads to slower growth in both China and the US. Probably growth slows more in China because it's more open to trade, and trade drives more of its growth. The US, it's a bigger, and it acts almost like a closed economy, relies a lot more on domestic demand. So if the escalation of trade tensions is contained in this way and it remains a bilateral issue between China and the US, we think it can slow the global recovery, but it should not be a trigger for it to stall altogether and for us to hit a global slowdown, a meaningful one. And then if we take any indication from what happened with NAFTA, eventually we got there with the USMCA deal, and so that rhetoric and escalation that was very heightened up here resolved. So we're expecting a better resolution in terms of trade relations with China as well.
Very good. More questions, comments? There's one at the very, very back and one here. Let me go to the back.
Thank you. It's a bit of a thought experiment for Fred. So naturally, the demand for excess reserves in commercial banks around the world is a function of the interest rate that the central bank is paying. You have in Japan, banks are getting negative rates. The Eurozone, negative rates. Swiss National Bank is paying negative rates. Yet in the US, the Fed is paying above the Fed funds rate. So naturally, there's not a big clamor to reduce the size of the balance sheet. In fact, a lot of banks are thinking, hey, great, you're going to pay me this great rate, keep the balance sheet high. So let's just think the thought experiment. Suppose the Fed at some point says, we're going to pay on excess reserves 100 basis points below the Fed funds rate. What do you think that would do for the yields on 1 month, 3 month treasuries? I mean, presumably they would come down, wouldn't you think?
Yeah, I would agree with that. Presumably they would come down. I think that whole front-end interest rate complex kind of trades in a very competitive fashion. So to the degree that there's an investment opportunity that no longer exists in terms of producing a yield that's comparable with bills right now, the yields would decline.
Very good. And there was a question here, please.
I have two questions, actually. The first one goes to the representative of Uruguay. One of your debt management strategy, you said, is to secure enough fund up to the total of 1 year debt cost, so that you say it's an insurance for you to manage against the risk of default. I was just curious. I don't know if I'm correct, but that's how I understand it. I'm curious why not think of the other tools of managing such risk that are exchange and buyback. Why you don't consider? My second question goes to the moderator. You have publicized that you have a product to convert debt currencies. To convert currencies. To convert a debt labeled in one currency to another currency. Is it available to all countries? And how much is it? How expensive is it for countries to buy that product?
You first.
Yes, you're right. We've run a very conservative pre-funding policy, mostly relying on self-insurance and have enough liquid assets to cover debt servicing costs, interest and amortization for the next year. And indeed, it shows the market not only that we are willing to pay and honor our debts, but that we have the capacity to do so. But more importantly, it gives us a lot of flexibility in deciding when and how to tap the market. In other words, we are not pushed against the wall to have to go to the market irrespective of what the market conditions are. And at this time, when there's a lot of volatility, having that option in choosing critically the window when to access the market is key, catching the right window. So we think that also having that buffer gives us much more leeway in our decisions. Now, we also have developed liability management strategies in which we don't only, in the new issuance process, we also tack on a liability management operation to buy back part of the outstanding stock. Now, typically liability management operations are useful because you take the refunding risk off the table, and you're able to recycle shorter maturities for longer maturities. But I would say in this current environment, and going back to what I was saying about liquidity, adding a liability management operation is also a way to signal the market that you're willing to increase the outstanding size of the final bond. Basically because you would be issuing beyond your cash needs, and a portion of that would be issued by recycling older bonds. So going to your question, we use both self-insurance, but also liability management operations, which comes very handy based on investors' preferences.
Very good. On the quick question to us, yes, the currency conversion service is available to all our members. Of course, we need to have a swap market where to go, and at the final price depends on what that market says about your local currency. So it's available to all, but depends on each country's circumstances how pricey it could be. More questions and comments? We have a couple of minutes. Yes, please.
I want to ask about this: what we need to fulfill to participate in this what you have said, the World Bank access.
Oh, I seem to have hit on a demand that was there. Happy to talk to you more about it. The currency conversion, you mean?
Yes, conversion. What we need to fulfill, this is one. The other is to all panelists. There is a question, is there life after death, it says. So is there death? Is there life after death? Please answer this question. Thank you very much.
I'm happy to talk to you individually about the currency conversion service because it's available to everyone. There are no conditions. This is a Treasury operation. It's not we lending you money as a typical World Bank project. So there's no conditionality. It's just the issue of having a swap market where we can then get to the foreign currency you need. On the overall question, this is a good way to close the panel. Is there life after death? Let me translate that is there life after all these risks? What do you think? Let's go at 1 minute each and we close the panel.
Sure. I think it's a great question. I think we should be looking at debt also. With this increased levels of debt in recent years, we've been looking at it as a burden, as a bad thing, but I think financial market access and debt it's a good thing when you look at how you can use it to fund big infrastructure projects, to enhance the potential of the economy, productivity growth, and the supply side. If you look at it that way, to invest in education, when you look at it like that, debt is a very useful tool. So then the future of debt becomes about managing it well, not overburdening your economy with it, and how we manage the challenges of demographics, various geopolitical issues, and how we manage that and how we manage that in this new world. But I would say yes.
Fred?
Is there life after debt? So I guess my kind of snarky answer would be yes, it's called equity. No, I mean, the history of the world is that debt has been issued, and I think the world will go on. So yes, there's life after debt.
Herman?
I think there is, and you were talking about risks, and one of the things that markets are increasingly paying attention to is the entire sovereign balance sheet when assessing risks.
That's right.
Of a countries, and it's been very clear in the case of Uruguay. A lot of fiscal activity happens outside the general government, and many investors are aware that a lot of, say, debt from public corporations are brought into the balance sheet of the general government when crises occur. So I would say that in terms of thinking about risks, especially fiscal risks, what has come out of our interactions with investors is to focus on the entire comprehensive sovereign balance sheet.
Well, thank you very much. You will agree that it's been a tremendous panel. I won't try to summarize. I will just share my overall feeling, what I will take home. And my feeling is very similar to the feeling I had when my then teenager son was driving our car. You know, when you look at him, he was doing all the right things. He had great reflexes. He knew the law, and we were going straight. But somehow I was always anxious. This is the same I feel about your description of the global economy and how that will impinge on sovereign debt. Having said that, thank you all very much. I understand we have a coffee break now. Please. Thank you.
So many thanks for the panelists. I know it's been a long morning, and I'm sure you all are looking forward to having a coffee break. Before that, just very quickly, let me give you some information about the next breakout sessions, which will be in different rooms. You all should have received the agenda. You can look especially at this short version of the agenda. It's very helpful to look at the different breakouts and the different rooms. Basically, the breakout session 1 on foreign currency selection, 3 ways to solve the puzzle, will be held in room MC 2800, which is on the 2nd floor. Please take the elevator from this side of the auditorium, your left side. Event staff are here to direct you to the breakout rooms. You can see my colleagues there with a signal for the room. Breakout session 2 on how to address the accumulation of risks in subnational debt management through capacity building and stronger coordination will take place in room MC 13121, which is on the 13th floor. If you want to go to that session, please take the elevators right by the globe. On the right side of the exit, on your right side, you can see my colleagues with the signal over there as well. And finally, please know that the coffee break, coffee and refreshments, they will be served outside of the breakout rooms, not this room, so that we encourage you to go straight to the breakout rooms where you want to have your session, and there you're going to have the coffee breaks. So thank you for your attention and have nice sessions.